What's up, guys? Back with another video today. Today I'm gonna get into foreign exchange. Now, I'm not gonna get into technicalities of it, such as pips, etc., forex. I'm not gonna get into that. Just gonna get into basic definitions and what you need to know for foreign exchange. I will probably make a second video on this for the fact that I don't have my other notes on foreign exchange with me right now, but that's okay. I'll make another one. So let's get started. Basic definition. So you have spot and forward rates, or spot and forward transactions. So a spot transactions is the near immediate exchange of bank deposits completed at the spot rate. So what is the spot rate? The spot rate is the current exchange rate as of now. So let's say you want to exchange currencies right now. Whatever rate is hovering right now is the spot rate right now, point blank. If you want to lock in a future exchange rate, because you're saying, well, if I do it at this exchange rate, I'm probably going to get less out of it, or maybe it's going to have more transaction fees. But if you go in with the forward rate, which means you lock in a future exchange rate, you probably have less transaction fees, or you have something that's greater for your buck when you exchange currencies. So it depends what you want to do. A spot rate, you do it now, get it over with. A forward rate, you lock in and say, down the line, I'm going to exchange. That's the basic forward and spot rate definitions. Now, for demand, we talk about supply and demand now, which drives the foreign exchange market. If demand for a good from a particular country increases with no limited supply, that means that the price will increase. No limited supply from elsewhere. So what I'm trying to say is that, let's say you have a certain good in the United States, and everybody's saying, well, I want this good, I want this good. So more people are attracted to the good. What are companies going to do? They're going to hike the price, because simply, if there is no limited supply elsewhere and everybody's going after a good, they're going to say, well, we want our money's worth. Let's go ahead and raise the price up. Another thing about foreign exchange is that banks buying foreign currencies increases the price of the currency in the country. So say you have Bank of America, or let's say you have Wells Fargo, or let's have a big bank, JP Morgan Chase. Let's say you have a bank in America, well known, credible. They're going to buy currencies. So let's say they buy the yen, the yuan, say they buy the euro, say they buy the British pound. Wherever they buy that foreign currency at is going to increase that currency in the specific country, because you have somebody investing in that country. So we all know that the dollar may be going down a little bit as of right now, or people are saying that it's weak. But however, the dollar is still strong because a lot of countries rely on the United States dollar. A lot of countries back their currency up with the United States dollar. A lot of countries say you can use USD here. We don't care about it because the United States is a global superpower. The United States has proven, hey, we're one of the dominants, if not the dominant country in the world. Now, this is nothing political. I'm just saying this is how I think of it. So because probably maybe 90-95% of the world has some type of relation to the United States dollar, then the United States dollar is still going to stay strong. Now, all else if equal, if anything happens with banks falling or banks going insolvent, that's another story. But for the foreign exchange market, if any bank buys currency in a specific country, that currency goes up because more people are backing it. It's more credible. So it says your country's currency appreciates relative to another currency, and your country's goods price abroad and foreign good prices in your country will change. So what am I trying to say? So for foreign exchange, say we're in the United States again. I'm just going to use USA, make it simple. United States currency appreciates relative to another country's currency depending on what happens. So let's say USD goes up. And let's say the United States currency, when it goes up, the country's goods, so let's say all the goods, not the services, just all the goods prices go up because the dollar is strong. Abroad, however, not in here, not in our country, but abroad, because dollar is strong, everybody around the world saying, okay, we have to match that. But foreign goods prices in the country go down because the United States currency is super strong, that it's going to go up with the foreign goods prices, and it's going to go down with, it's going to go up with the country's good prices abroad. So if you're selling, what do we make here? Let's say you're selling chargers. Let's say you're selling chargers abroad, and the United States currency is appreciating. USD, because it's appreciating, that charger is going to be worth more abroad. Now, let's say foreign good prices in your country go down. Let's say you have Nissan, they're a Japanese company. Say you have Infiniti, Japanese. So that good, that car is going to be lower. Everything's tagged on the US dollar because it's appreciating. Now, foreign good prices in our country are going down because when people are going towards the dollar. So another example is that let's say the US dollar appreciates compared to the British pound. The US's good prices will increase abroad and the foreign goods prices will decrease in the USA. Vice versa. Let's say the British pound appreciates, USD goes down. Now, the British goods increase abroad, the foreign goods, or United States, decrease in Britain. Now, let's talk about foreign exchange trading. Just want to get some basic facts out the way. The volume exceeds $5 trillion per day. Now, this is back from 2021, of fall 2021, so maybe it's greater today because a lot more people are getting to the market. But it involves buying, selling bank deposits denominated in different currencies. Transactions typically in excess of $1 million because everybody's trading currencies, bank deposits, trying to make arbitrage. So, exchange rates in the market are influenced by supply and demand, or law of one price. So what is the law of one price? It is a price of an identical good will be the same throughout the world, regardless of which country produces it. So you're saying, well, how does that make sense? Well, think of it this way. The price of an identical good will be the same throughout the world, regardless of which country produces it. This is where foreign exchange comes in. Let's say $100 of US steel equals 10,000 yen for Japanese. So you're saying, well, based on foreign exchange, $100 of US steel is going to equal 10,000 yen. Let's just say it like that because it's equal. It's 100 around the board in terms of USD, or it's a 10,000 around the board in terms of yen. So everything is equal, just in different denominations because of currencies. Because some currencies have more zeros than others. Some currencies are worth more than others. Some currencies are worth less than others. It depends on the currency, but everything is across the board identical. It is equal in price. Despite it saying different, because some currencies have different denominations, the price of an identical good will be the same throughout the world. Law of one price. Now, let's talk about triple P, purchasing power parity. So it's when exchange rates between two currencies will adjust to reflect changes in price levels. So the exchange rates between two currencies, so let's say you got the pound, let's say you got the US dollar, will adjust to reflect changes in current price levels. Here is the problem though about that. All goods aren't identical in both countries. You got to know that. All goods are not identical in both countries. Now you say you got the law of one price. So yeah, it's the price of identical goods, but the thing is all goods are not identical. Some things may be made cheaper, some things may be made more expensive. So many goods and services aren't traded. That's the problem with triple P. Now, another thing about things in the foreign exchange market is that a basic principle is if a factor increases demand for domestic goods relative to foreign goods, the exchange rate goes up. So let's say anything that drives demand for domestic goods relative to foreign goods, the exchange rate goes up. Now, relative price levels is the rise in relative price levels cause a country's currencies to depreciate, because when the prices go up, more people may not be able to afford it. So maybe the currency is getting a little bit weaker. Maybe things happen because you have inflation. Maybe things happen because the country needs to make more money. So this is just what's happening with the exchange rates. Let's say you have a tariff put on things or a quota put on things. Increasing trade barriers because you put a tariff on something causes a country's currency to appreciate, because now you're saying you cannot have access to it like you used to. You cannot have access as immediate to this thing. You have a tariff, you have a quota, you have to meet something for this. So now it's saying, well, that good is worth more now because it's not openly traded on the market anymore. It's not openly given to people anymore. You have to earn this. So therefore, the more barriers there are to getting that good, it's going to be worth more. Now, if a country is more productive relative to another, its country appreciates. So let's say you produce more than another country, then your currency will go up because you're producing more and more people are going to be backing that. Now it says increased demand for imports. Imports causes domestic currency to depreciate because you're not relying on the things from your country. So let's say that the United States is relying on imports from a different country. And they're saying, nah, we're really not going to export like that. We just want to import more. They're like, okay, so the United States is not being credible in holding their own production. Therefore, they're not productive to another country, so the USD is going to go down. because they're relying on everybody on the outside. But vice versa, increased demand for domestic goods equals domestic currency going up. So if more people want to rely on domestic goods and say, we want to back our country, we want to back our dollar, we want to back our money, therefore, when it goes up, currency goes up as well, because you are relying on your country and you are putting your money into your country to boost up your currency. So here's some quick things to know about foreign exchange. We're going to end the video right now. To have the exchange rate response, factors to increase it: domestic price level will depreciate it. So domestic price level, it will depreciate. Trade barriers will appreciate, like I said, tariffs and quotas. Import demand will depreciate it. You're not relying on your country. Export demand will appreciate it. Other people are relying on you. Your currency is going up. Productivity will appreciate it. So when you're productive, when you're making more things relative to another country, people are going after it, it appreciates. So that's a little bit about foreign exchange today. Thank you guys for watching. I will get into a second video, get my other notes going. Thank you so much. Appreciate you guys. Please tune in for the next video. See you next time.